Hey, good morning. Let's go over today's trade plan. So in the overnight session, the sell side has been more dominant and active, but at the same time, ES is set to open near the recent balance area low. So in order for the market to continue going lower, we would have to see sustained downside momentum and excessive weakness in the broader market. So heading into the open, we are going to be using 64 quarter to 66 quarter as the micro bull bear zone. And as long as we are seeing that sustained downside momentum and the other markets are also participating in the move and ES is holding below 64 quarter to 66 quarter, then it would indicate that this is developing into a short-term balance breakdown. And from there, the market can go down into 55 half to 58 and 51 quarter to 53 quarter. But because we are opening near the balance area low, the onus is on the sell side to prove that they are indeed in control. Because simply a lack of weakness at the bottom of this balance area can result in a short-term bounce back up towards the gap fill and the 70 to 72 half initial resistance, which is really going to be key in defining and helping us define the bias on the day. So holding below the micro bull bear would be a confirmation of weakness. 70 to 72 half is still an area where sell side can be active, and if we break out above 70 to 72 half, then that would confirm a solid rejection at the balance area low and bring the upper resistance zones into play at 77 to 79 all the way up towards 87 to 89. So right now, heading into the open, the main thing to look for is whether there is sufficient weakness and downside momentum for the market to continue going lower. Because we're opening at the balance area low and at short-term support, there is the possibility of responsive buyers being active at this area and pushing price back up towards 70 to 72 half. So off the open, we just need to make sure there is enough weakness to justify and sustain a move lower below 64 quarter to 66 quarter, and absent any strong selling, buyers can jump in and we can see a move back up towards 70 to 72 half. So that means we do have to be cautious on entering any aggressive shorts off the open. It doesn't mean the idea can't work, but we need to look for certain things. We need to see excessive weakness on the advanced decline. We need to see the other markets continuing to hold below their recent levels. And at the same time, we want to see sustained downside momentum. Without that, it's going to be tough for the market to sustain these lower prices, and we can get a move back up. So 70 to 72 half can still potentially be a spot where the market can provide a short setup, but it's going to depend on how it gets there. Because the only time it'll make sense to short 70 to 72 half when there is still enough weakness in the market that there is the possibility of breaking and going much further below the micro bull bear. If we're seeing upside momentum, for example, as the market goes up to 70, 72 half and the tick is printing new highs, then the low may be in. And then it's not going to be worthwhile necessarily just to trade that zone for a small rotation. So it is going to depend on how that zone gets tested. On the downside, as long as we're holding below micro bull bear and the November 9th low of 2062, like I said, the market can go down to 55 half to 58. As far as the support zones below go, the only time that we will fade those support zones is if there is a lack of excessive weakness. If, for example, the market's going down and the advanced decline line is not really supporting a big downside move, or if we're going down but there's really not a whole lot of downside momentum behind the move, then perhaps we can consider it. But we do need to be careful on taking fade setups at the support zones, because if this does indeed develop into a proper balance breakdown, then we can quite easily go down towards 51 quarter to 53 quarter and possibly even down into 47 to 49 and the 45 half naked VPOC and 42.75 to 44.75. So then, the sell side will be in control, and this will be a minimum a 3 to 4 day balance breakdown, and it will be breaking below even a larger time frame structure over the last couple of weeks. So we do have to be careful at fading the support zones. We don't want to fade if it's developing into a trend down day, for example, right? So we would only want to fade the support zones below if the underlying market environment was telling us that this is not really a trend day and that balance is still possible. Then we can consider fading the support zones and looking for a move back into the recent balance back above 62 and 64 quarter or 66 quarter. But if that is not really a probable scenario in real time and we're seeing excessive weakness and it's developing into a trend type day, then we don't want to fade the support zones, and those will be better served as downside targets. So those are really the main ideas heading into the open. So off the open, keep an eye on 2062, 64 quarter, 66 quarter. That'll help define the bias right off the open. Keep an eye on the advanced decline, the NYC tick, to just monitor and see whether there is sustained downside movement that can really support a proper balance breakdown. Because like I said, absent strong selling, responsive buyers can jump in and we can see a move back up towards 70 to 72.5. So those are our main thoughts heading into the open. Let's see if the sell side can indeed maintain control, and we'll take it from there.